In the first presentation on global imbalances, we really focused on global imbalances from a current account balance perspective. So we were looking at how in countries in the what I've been calling the West have been running current account deficits, so that's mainly the United States, and countries in what I've been calling the East, mainly China, Japan and other Asian countries in the Middle East, as well as Germany, are running current account surpluses. But really, to understand why global imbalances are a problem, we need to start looking at the concept of global imbalances from a net foreign investment perspective. So rather than looking at current account balances, we need to look at the flows of money between countries. So we're really switching to looking at, in this slide and for the rest of this presentation, looking at global imbalances from a capital financial account imbalance perspective. And what I mean by capital financial account, when I say that, I'm referring to investment flows between countries. So hopefully that makes sense. So let's start looking at global imbalances not from a trade perspective, that is from a current account perspective, but more from a foreign investment perspective. And what I mean by that will make plenty of sense when we start revisiting these charts. Now I know we have looked at these charts previously, but let's have a look at them again and look at them with the concept of global imbalances in the back of our mind. The first thing that we see is that in the United States there is a very large, or there has been a very large, savings investment imbalance since the early 1990s, and even really going back into the 1980s. But the imbalance between savings and investment really did get quite large in the late 1990s going into the 2000s. And so this big negative savings investment gap in the United States meant that America was receiving a lot of foreign investment money. So America was experiencing inward net foreign investment. So they were borrowing money from the rest of the world or receiving foreign investment funds from the rest of the world. Another way of interpreting that is they were receiving foreign savings. America receiving foreign savings to finance their negative savings investment gap, that's the same as them receiving foreign investment. So foreign savings flowing into America is the same as foreigners investing in America. So sometimes we use, when we're talking about foreign investment, sometimes I use that word interchangeably. So because America's savings are a lot less than its investment, it needs to borrow foreigners, or the savings, the excess savings of foreigners. That's the same as saying foreigners are investing their savings in America. Now, where is this money coming from? Well, by now you should know the story. It's been coming from a positive savings investment imbalance in Japan, and it's been coming from a positive savings investment imbalance in East Asia, the same in China, the same down the bottom in the oil producing countries. So what we're seeing here is positive savings investment imbalances in a lot of countries around the world, and they are sending that money primarily to the United States. And they certainly were doing this leading up to the global financial crisis, and as we'll see in the next topic, that was one of the fundamental causes of the global financial crisis. And so this is another way of defining global imbalances. We've looked at it from a current account deficit, current account surplus perspective. Now we're looking at it from the other side of the same coin. That is, we're looking at it from an investment flow perspective. And certainly we have a lot of outward net foreign investment in Japan, in China, in East Asia and the oil producing countries, and that money is going to the US in the form of inward net foreign investment. Okay, now before we get on to the last slide where I've got 5 points of, or 5 problems associated with global imbalances, let's stop and think about the implications of this monetary flow from current account surplus countries to current account deficit countries. So what I've got here is a very simple use of the S minus I NX model. And on the left hand side, I've titled that graph Current Account Surplus Countries. Now, these are countries such as Germany, China, Japan, other Asia, and the oil exporting countries. And on the right, current account deficit countries, I'm mainly talking about the US and, say, the UK. Australia's in there as well as a current account deficit country. Now, along the bottom, I've got this green arrow. At the bottom, I've got this green arrow, which is labelled monetary flows from net foreign investment. What that means is that these current account surplus countries are sending excess savings or undertaking net foreign investment in the current account deficit countries. So investment money, excess savings, are flowing from the east to the west, from left to right. Now that is doing a couple of things. This monetary flow is doing a couple of things, or the monetary flow from NFI is doing a couple of things. First of all, in the surplus countries, it means that the net foreign investment line is well to the right, and it's sitting at a positive value of $300 billion. Now the countries that are receiving all of this outward net foreign investment, their net foreign investment line is negative, indicating that they are actually receiving foreign investment money in net terms from other countries, rather than being foreign investors in other countries themselves. They are the countries on the right here. In the right diagram, they are actually receiving foreign investment money. Now that has an important implication for the country's exchange rates. So what we're seeing here is that the current account surplus countries, because they are sending excess savings overseas, this is holding their exchange rate low. It's holding their exchange rate low because it means that their net foreign investment line is far to the right. And the countries who are running current account deficits, their NF line is far to the left in their diagram, meaning that equilibrium for them will occur at a very high exchange rate. So because we have large volumes of money moving from one group of countries to another, it actually creates exchange rate misalignment. Now, of course, right at the top here in between these two diagrams, I've got monetary flows from trade. What that means is that as investment money flows from the left-hand side to the right-hand side, trade money flows from the right-hand side back to the left-hand side. So we do have external balance in these economies. We do have a situation where inflows equal outflows. It's just that the countries on the left, such as Japan, China, Germany, the oil exporting countries and other Asia, those countries are sending their excess savings to the West, and in a way the West is sending that money back by running current account deficits. So hopefully that makes sense. The main point here is the exchange rate misalignment that is created by this, and a very low exchange rate on the left means that these countries will be sort of naturally running current account surpluses, and the high exchange rates on the right mean that these countries will naturally be running current account deficits. Okay, so to finish up, global imbalances problems. Now, of course, you need to have an understanding of how the global economy can go about rebalancing. And I've provided readings, plenty of reading material on that, so I would arm yourself with 2 or 3 important points or important ways that the global economy can actually go about rebalancing itself. There's plenty of information out there. I just need you to read that information and really focus on the rebalancing side of things, because I'm not going to address that in these lectures. I'm sort of leaving it more for you to do a little bit of reading yourself and figure it out yourself. Okay, so the problems associated with global imbalances. First of all, the countries that are running current account deficits, so I'm dealing with point number 1 now. The countries that are dealing with current account deficits, they are naturally receiving a lot of foreign investment money. That is the flip side of their current account deficits. Now, if they are receiving a lot of foreign investment money, and this inflow of foreign investment money into the current account deficit countries, if it is large and persistent over a large number of years, it means that an increasing proportion of that country's shares and real estate will be purchased by foreigners each year. At the same time, some of this money, the money that isn't going into the stock market, the foreign investment money coming into the current account deficit countries that is not going into the stock market, not going into the real estate market, is probably going into the bond market. And that then increases the country's foreign debt. And so rising foreign debt in current account countries is an important issue as well. So the first point is really saying one of the major problems with global imbalances is that an increasing proportion of the assets of these deficit countries are being owned by foreigners. Okay, so rather than owning your own assets, you are selling your assets to foreigners. Now that can become dangerous, because if something happens in one of these current account deficit countries and foreign investors want to move their money out of the asset markets of these deficit countries, if foreign investors want to move their money out of the asset markets of these deficit countries, it could cause a currency crisis. So relying so much on foreign money, foreign investment money, can leave you exposed if your country does go into or if some sort of crisis starts in your country, then it does leave you exposed, because those foreign investors are much more likely to rip their money out of your country than locals would be. So if locals owned these shares and real estate and debt by having a higher domestic savings rate and not having to rely on foreign money, if locals owned all of these assets, it's less likely that during a crisis foreigners would rip their money out of their own country and send it overseas. Certainly there would be an outflow of money. Even if locals owned these assets, some of these locals would sell that money and move it offshore, but it is less likely to happen. Okay, point number 2. Investment positions of the current account surplus. What I'm saying by point 2 is that the current account surplus countries begin to hold, or their investments in these deficit countries become increasingly large. And you're eventually naturally going to get to a point where the surplus countries have lent the deficit countries so much of their savings, invested so much money in these deficit countries in the form of foreign investment, that these these surplus countries begin to face substantial sovereign, corporate and exchange rate risk. So sovereign risk is risk associated with government, corporate risk is risks associated with owning the shares or the bonds of some corporation, and exchange rate risk is just having the risk associated with having your money in another country and maybe experiencing an adverse exchange rate movement, i.e. a depreciation of that currency while you are invested in that country. So just having so much money invested in these current account deficit countries really does expose you to a little bit of risk, and eventually these surplus countries may get to a position where they stop lending to the deficit countries. Point number 3, misalignment of exchange rates. So I was talking about the misalignment there, how exchange rates are generally quite low in current account surplus countries and quite high in deficit countries. The risk associated with that is that the surplus countries, because they send their excess savings overseas, they will have a low exchange rate. The risk then becomes that these surplus countries will become overly reliant on the deficit countries as purchasers of their exports. So in other words, the surplus countries, because they have a low exchange rate, may focus too much of their domestic production on exports, and they will become exposed if there is an economic downturn in the countries that are buying the bulk of their exports. And the countries that are buying the bulk of their exports are these current account deficit countries. Now, China has acknowledged that in recent years, and what China is now trying to do is develop more of a consumption culture amongst its booming middle class. So rather than relying on America and Europe as the main drivers of their economy, the main customers or the main buyers of their exports, China is increasingly focused on increasing the consumption levels of this booming middle class, so that more growth in the Chinese economy can be driven by consumption growth of its own citizens. So that's also related to point 3. Point 4 is a point that I've made previously in this set of slides. Global imbalances really indicate that countries that are running current account surpluses are really underspending. In a way, they have too much in terms of excess savings. And deficit countries, in a way, are overspending. Deficit countries are in a situation where they are spending so much money, they're purchasing all of their own output, in a way, but they're also purchasing additional or spending additional money on purchasing imported goods as well. So deficit countries are kind of, in a way, overspending. Now, that sort of situation where deficit countries are continually running current account deficits, which means that they are actually overspending and using foreign investment to fund that overspending, that can't last forever. And eventually, the surplus countries will become sick of lending to the deficit countries, and painful adjustments may occur. And those painful adjustments are likely to occur if the foreign debt levels of these deficit countries just get unsustainably high. Foreign lenders, the surplus countries, may then look at these deficit countries and say, we've loaned you enough money, we're not lending you any more. And then that sort of leads us into number 5. There could be the threat of a sudden adjustment. Because global imbalances mean that current account deficits are reliant on current account surplus countries for savings, eventually we could get to a point globally where a lot of these deficit countries have just simply borrowed too much. And this is a situation that perhaps the United States is getting close to. They're running big current account deficits. They're financing those deficits by borrowing money from current account surplus countries, and maybe those current account surplus countries, the big lenders to America, China, Japan, the Middle East, Germany, maybe those countries are very close to a point where they don't want to lend the United States any more money. And if that happens, if America's source of international credit stops, then some very painful adjustments will need to take place in the US economy. And I encourage you to read a little bit more about those painful adjustments. And there's a lot of reading material on this topic that I've given you that is relevant for this. But certainly global imbalances are a very important part of the course, and one that you need to do quite a bit of work on.